Well, Kumba's full-year headline earnings per share fell 28% to 37 Rand 97, and that due to above-inflationary cost escalations and a decrease in the iron ore price. A final cash dividend, though, of 12 Rand 50 has been declared, and earlier today I spoke to CEO of the company, Mbazima, to get more insight on the numbers.
It was a very difficult year. Some people call it a baptism of fire, I think. But the most difficult thing, I think, was the strike that took place in the fourth quarter. That is really what was very difficult for me personally and for Kumba. We lost 5 million tons as a result of that strike. The prices will be the prices. We're very disappointed that they came down to the level that they did. And they affected our earnings quite significantly, as you'll have seen. But we are seeing some support for the prices right now, so I've got much better hope for 2013 in terms of price.
Let's take a look at where that support is coming through from, because to a large extent you've got to look at the supply-demand scenario, and a Reuters poll shows that iron ore global supply has outpaced improving demand from China. I mean, are you comfortable with where that supply-demand dynamic is sitting right now?
We are quite comfortable. There was a lot of volatility last year in the supply and demand scenarios as we went forward. And we think most of the fundamentals have kind of settled down now. And we're expecting a very modest increase in crude steel production next year, between 1% and 2% increase. And I think most of the supply things have happened in last year. And we will be seeing some increases next year as the majors start moving their projects forward. But we expect that next year will be more or less balanced as we go forward.
Mm-hmm. Take us through production on your side, because a lot of emphasis this time round being placed on Kolomela and the kind of contribution it's made to your capacity as a whole, and of course that where Sishen came under pressure in the fourth quarter.
Kolomela has been a fantastic project. It ramped up very quickly, much quicker than we had expected. And in the last 3 months of the year, we were producing actually above the 9 million capacity. This year, we expect that it will produce to the 9 million capacity, because we will have a more balanced mine. We'll be balancing our waste versus our ore for the year. So very, very happy with Kolomela. Sishen was affected by the strike. And as I said, we lost about 5 million tons production. We are getting back to speed now. We have replaced all the operators that we dismissed as a result of the strike. And these guys are in training, and they'll be getting up to speed in this Q1. So we expect that Sishen will be going well the rest of the year. However, we're expecting to increase waste stripping by between 40 and 50 million tons. That's a bit of a tall order, but we're looking forward to doing that. And therefore, we expect production from Sishen about 37 million this year.
Let's take a closer look at the labour environment here and your assessment of it and managing it, because, I mean, we've seen Kumba Iron Ore give pretty hefty bonuses last year, and, you know, it just proves that buying labour, keeping labour on your side is a very difficult feat right now. How are you managing labour relations?
Look, we were surprised at the strike last year, because we do have very good relationships with our employees. But there were lots of things happening in the mining industry last year that would have fed into what was happening at Kumba. We're hoping that now that we're over this, we can sit down and talk with our employees and talk about what our relationship ought to be going forward. We have a collective agreement that runs for 2 years, and therefore we would not be in negotiations this year. We'll just apply an increase on 1st of July as already agreed. And we hope that the employees can see that when Sishen is going strong and when Kolomela is going strong, everybody benefits.
Mm-hmm. Do you find that there's a shift in the tone of conversation that's happening between business and labour right now, specifically after all we've heard at the mining Indaba, after all that's been going on in the labour environment in South Africa, in the mining industry at large?
The labour environment remains challenging. There are retrenchments happening in the industry. There are discussions about shedding labour, etc. we're lucky that we're not going to be shedding labor. In fact, we'll be increasing labor because of the increased waste stripping that I'm talking about. So the conversation is slightly better. Having said that, it's an industry issue, and therefore we've always got to be alert that there will be no contagion into Kumba.
Of course, that puts a bit of the spotlight on beneficiation as well and the progress you're making in that regard. We had Kumba launching Project Phoenix, which is currently in the feasibility phase. But take us through the kind of growth you see in that regard, because government placing a lot of emphasis on beneficiation and the role that mining companies need to play in that regard.
I'd like to emphasize that we support government's objectives in this regard, i.e. to be able to increase the economic activity in the steel sector in South Africa. And we have always played our part, and we'll continue to play our part in to be able to provide ore to the domestic market. And as you say, Phoenix is one such project which we hope will be able to produce some 3.4 million tons of ore for the domestic market going forward. We've been discussing and we'll continue to discuss the details about what price domestic people should be able to get iron ore, and it's certainly not export prices.
And certainly not prices that you've had in place with ArcelorMittal either.
What we've had in place with ArcelorMittal before was 6.25 million at cost plus 3%. We don't think that's an appropriate price to pay. An appropriate price for the local industry is a price that will meet the costs and give an appropriate return to the miner.
What are your projected margins moving forward? I mean, we've had operating expenses up 39%, and that's reduced your operating profit by 10.5 billion rand. So where cost efficiencies have to be front of mind right now while you make these capital investments, the kind of margins we're looking at moving forward?
We've had some healthy margins. I think in 2011 we were at 65%, and this year we're down to 51%. But mostly it's as a result of the prices that I talked about and having come down significantly during the year. And if we have better prices, we can expect our margins to improve somewhat. Cost pressures are very high. They've been very high. For example, diesel went up 16% last year. But we expect that with the asset optimization, we'll be able to mitigate some of the effects of cost increases in the future.
Norman, were things too easy in the past? Are the good times over, or are we merely at the bottom of a cycle now that is going to turn?
The iron ore business is a good business to be in. I expect that we'll be delivering value to our shareholders well into the future. However, in the long term, we do expect that iron ore prices will come down significantly, but that's not in the next 3 to 5 years. That's in the longer term.